Hey everyone, welcome back to Corporate Decoder, the place where we break down these massive corporate reports and figure out what is really going on behind the numbers. It's like a treasure hunt. But for business secrets, so today we are diving deep into some very meaty SEC filings from Ivy funds. It looks like they've got a lot of funds under their umbrella, and boy oh boy are there a lot of numbers to sift. Through, but don't worry, that's what we're here for before we get into the nitty gritty of these financial statements. If you appreciate getting straight insights from corporate documents, make sure you're subscribed and hit that notification bell so you don't miss our next deep dive. We also have a Discord community linked in the description below, a great place to discuss all things corporate finance. Alright, so this filing is essentially a shareholder report for registered investment companies specifically covering the period up to the 30th of September 2025. Think of it as a financial checkup for these funds, giving shareholders the lowdown on how things are going, their costs, their holdings, and basically everything they need to know to feel confident about their investments. Let's cut to the chase. The financials are usually the most interesting part, and this report is packed with them first. We see a hypothetical breakdown for a 10,000 investment in different share classes of the Macquarie Core Equity Fund. For instance, class of shares had costs associated with them like $54, which is about 0.99% of the investment. Now, for some key statistics from the 30th of September 2025, the Macquarie Core Equity Fund had net assets totaling a massive $39 billion. That is a huge number, and it tells us this fund is a big player in the market. They hold about 50 portfolio holdings, excluding cash and cash equivalents. And the total advisory fees paid during the reporting period were over $11.5 million. The portfolio turnover rate was around 15%, which suggests a strategy that isn't constantly buying and selling a lot of stocks. Digging into the sector allocation, it's no surprise that information technology takes up the largest chunk at 3,446%. This sector has been a major driver of growth, and it seems this fund is heavily invested in it. Financials come in second at 2166%, followed by communication services and industrials. Each around 11%, these are all pretty standard sector. Ours to see in a growth-oriented fund. And who are the star players in their portfolio? Well, the top holding is Microsoft at 758%, followed closely by Nvidia at 652%, and Apple at 467%, Alphabet Class A, and Taiwan Semiconductor Manufacturing. ADR also make the list. These are all the big tech names you'd expect to see at the top of a tech. Heavy growth funds holdings, it screams tech focus, doesn't it? Now, this report actually contains information for a whole bunch of Macquarie funds, not just the core equity fund. We see the Macquarie Global Bond Fund with a whopping 320 portfolio holdings and over $430 million in net assets. It's a much more diversified strategy. YAI focused on fixed income, with the United States making up over 41% of its country allocation. Sector-wise, banking is the biggest slice of the pie at 17-19%, which makes sense for a bond finance companies come next at 367%, followed by energy communications. And then a few others. It is a broad mix focused on income generation, which is what you'd expect from a high-income fund. When we look at the top equity holdings for some of these funds, we see some recurring giants like Microsoft and Nvidia appearing across multiple reports. This suggests a consistent investment philosophy, or perhaps a conviction in these major tech players across different fund strategies. Let's talk about cost, because that is what directly impacts your returns for a hypothetical 10,000 investment in the Macquarie Core Equity. Fund class of shares, you would have paid $54 in cost, which is 0.99% of your investment class C. Shares cost a bit more at $95 or 174%. This difference highlights how share class choice can impact your overall investment cost. We're seeing these statistics repeated across many of the funds, like the net assets being over $39 billion for some of them, and a portfolio turnover rate of 15%. It's interesting to see how consistent some of these figures are across different fund types. This suggests a unified management approach, or perhaps strategic decisions affecting multiple funds simultaneously. The portfolio composition for the Macquarie Asset Strategy Fund shows a mix of common stocks at nearly 60%, followed by corporate bonds at about 16%. Then we have bullion at almost 7% and agency mortgage-backed securities at 685%. This is a very blended approach, aiming for different types of returns and diversification. Now, looking at the actual holdings data for Macquarie Asset Strategy Fund, it's incredibly detailed. We see a lot of bond investments, for example, agency collateralized mortgage obligations, like Fannie Mae Remix with specific interest rates and maturity dates, also agency commercial mortgage. backed securities from Freddie Mac multifamily structured pass-through certificates, and even some US Treasury bonds and notes. Looking at the statement of assets and liabilities for Macquarie Asset Strategy Fund, as of the 30th of September 2025, investments alone were valued at almost $17 billion. That is a substantial asset base, and their total liabilities were around $155 million, leading to a net asset value of close to $18 billion. That is a lot of money being managed. Now, this filing gets into the nitty-gritty of why these contracts are approved. The board considered a lot of factors, including the nature, extent, and quality of services provided by Delaware Management Company and their sub. Advisors, they looked at comparative expenses, the potential for economies of scale, management profitability, and even ancillary benefits. It's interesting that they specifically mentioned the upcoming acquisition by Nomura Holding America Inc. This shows the board is looking ahead, considering how that change in ownership might impact the fund's resources, and potentially offer benefits to shareholders. It is like they're saying, hey, things are changing, but we think it might actually be for the better with Nomura's global reach. While these filings paint a picture of a very actively managed set of funds, most of these funds have a significant tilt towards information technology, with companies like Microsoft, Nvidia, and Apple dominating the top holdings. This points to a strong belief in the continued growth of the tech sector. It's a strategy that has paid off handsomely recently, but also carries inherent risks associated with market con. C. Entration. What stands out is the sheer scale of assets managed, over $18 billion for the Asset Strategy Fund alone, and the detailed breakdown of holdings shows a sophisticated approach to diversification across different types of securities and geographies. The costs associated with these funds vary by share class, which is pretty standard but worth noting for someone picking a fund. Class. A and C shares have those sales charges, while institutional and R6 shares are for eligible investors and often have lower costs. This is a key factor to consider beyond just the performance. Alone, a major talking point is the proposed acquisition of Macquarie Asset Management's US and European public investments. Business by Nomura. This is a big deal, indicating a changing of the guard, and the board has already factored this potential transition into their advisory contract renewals. They seem optimistic about the resources Nomura might bring. Looking at the broader strategy, it appears Mac refunds are playing a long game focused on growth, especially in technology, but also maintaining some diversification through bonds and other assets, the natural resources. Fun. D, for example, has a strong emphasis on companies in the materials and energy sectors, which makes sense given its name now. For my take, this is a company that is navigating significant market shifts, not just with acquisitions, but also with a clear investment thesis in technology and growth. The waiver of fees noted in the report is a common tactic to attract and retain investors, but it's good to see it. Tat. Transparently disclosed, however, the sheer size of some of these funds and the concentration in tech does present some risks. A downturn in the tech sector or a rise in interest rates could have a significant impact on the overall performance. The real estate fund's focus on REITs also ties it closely to interest rate sensitivity and the broader economic sea. Lee. Made overall, Ivy funds are clearly trying to balance growth potential with managing expenses and risks. The acquisition news is also a major strategic move to watch and could significantly impact their future direction. What are your thoughts on this strategy and the impact of the Nomura acquisition? Let me know in the comments below. If you found this deep dive valuable, make sure to hit that like button and subscribe for more corporate financing analyses like this, and don't forget to join our Discord community linked in the description. We've got a great group discussing these filings and other market movers. Thanks for tuning in to Corporate Decoder. See you next time.